All right. Welcome everyone to the 1031 Exchange and Real Estate Planning Seminar. I am one of your hosts. My name is Melissa Tierney. I am a certified real estate planner and realtor. And joining me are two very esteemed colleagues that I have the pleasure of co-hosting and working with on many levels. We have Isaac Kim, who is a wealth manager from LPL Financial. He's a wealth manager, and he and I have a lot in common as far as how we advise our investor clientele. Also speaking with us today is going to be Charles Jensen, the managing director of Inland Securities Corporation. We're going to hear a lot of really great information from everybody, from stuff that we have really used in the field, and you're going to hear case studies and some other things. Our goal for you today is to come out of this webinar with a lot of information to really just help you ask better questions of yourself and your team, and also to just empower you to learn more about your situation so that you can make the most informed decisions as per your situation within your journey. So, we're just going to dive right in. If you need to get some water, get some coffee, take a quick break, that's fine. Just make sure that you are on mute so we can keep going with the presentation. And ultimately, our goal for everybody on this webinar is that they become more informed about the 1031 exchange process. And we just want you to feel empowered with knowledge so that you feel like you can make some really good decisions moving forward. So, with that being said, we're going to just dive right in. The first speaker is going to be me. My name is Melissa Tierney. Like I said, I am a real estate planner and realtor by trade. What that means is I essentially took my real estate license to the next level. You can find me in the field doing a lot within the senior transition, senior relocation, and just senior service space. I am very well connected in our local senior industry resources community. And what that means is my purpose is not to transact real estate. It's not just to transact real estate. My purpose here is to be part of a journey, part of a family's journey, whereby we work with people to build, protect, and transfer their generational wealth through their real estate. It's about being part of the journey and not just a transaction. It's about being that level of support, that multifaceted support that we also very much need within our own family circles. So, today we're going to go over a number of different things. Our goal today is to talk a little bit about helping you to really understand real estate planning and what we mean by the power team of four. And we're going to talk a little bit about the state of the market and how it pertains to the investment outlook. We're going to do a little bit of demystifying of the 1031 exchange process. There are a lot of myths and just general misunderstandings that people have about 1031 exchanges. So we're going to demystify that a little bit at a very high level. And then we are also going to go through the nuances of what makes a 1031 exchange, why it's so important, how it can help investors to unburden themselves in a lot of different ways. And as we know, in many families, the sale of real estate can certainly trigger disagreements. So we're gonna do a little bit of planning so that we can maybe spark your creativity in terms of how could we potentially prevent some family disputes when it comes to the family real estate. And with that comes minimizing and or deferring capital gains taxes. And ultimately, we just want to inspire you to take action as it pertains to your individual situation. So going back to a little bit about me and going back to what I mentioned as a real estate planner, essentially what I think is the affluent American family should have what I call the power team of four behind them. Every affluent family should have the family attorney. Usually that's in the form of estate planning or a trust attorney. And there's also the family financial planner who's helping to manage the family money. There's also the family CPA, somebody who is filing the taxes on behalf of the family and the estate, but who is managing the family real estate. And that's where I come in. It's a very multifaceted approach for seniors and their families to build, protect, and transfer the generational wealth through their real estate. And what that means for me as a realtor is not just coming in and looking for a transaction. It's more than that. It's coming in and working with that power team of four and asking more evolved questions, such as what are the goals of the family? What are we looking for in terms of legacy building? Maybe there are people, seniors in particular, who want to bless their kids and their families while they're still alive. And on that note, we have a lot of those conversations with people when it comes to planning not just the legacy, but also what happens with the family real estate. Because while retirement is a personal decision, it is actually a family affair because there's more involved than just somebody making the decision to retire. And everybody should be involved in that journey. And so being so well entrenched in this space means knowing what to look for in terms of supporting people to care and provide care for their senior loved ones in the family. And speaking of senior loved ones, did you know that one out of every three properties in the United States is a rental property? It's a lot of rentals that are in the United States. Most of those are owned outright free and clear by our senior loved ones. What happens when the senior loved ones get tired of managing calls? They get tired of dealing with what we say tenants and toilets. They get tired of that, but they still want to be in real estate. They still want to build that equity. They still want to build that legacy, which begs the question, what do we do with it? And that's where we come in. But a lot of that first step is knowing the difference between how to aptly support that senior loved one versus keeping on keeping on. And one of the biggest things I have is when it comes to helping a senior loved one to downsize, most people don't realize that you should be working with a senior move manager and one who is a member of NASM, the National Association of Senior Move Managers. It's actually a thing. Um, I have a whole seminar on that I do for my clients, but suffice to say, it's a real niche that I've had the pleasure of serving for many years, and I look forward to many more years of doing so. So the end result of all of this work is we ask really broad questions because we're part of a journey. We're not just involved in a transaction. So moving forward, can you guys see my screen or is it just me that it's not loading?
It's not loading fully.
Loading.
Okay. Well, I can still talk. So what's not loading in front of you is a graph. Um, yeah, it's not loading. Okay. So there's a graph, but for the sake of this presentation, I have a graph and I can email this out to everybody on the call. What this graph shows is, if you can imagine, it shows 22-ish years of Santa Barbara real estate activity as compared to the average interest rate. And some of the patterns that I want to call out is, first of all, even in the mid 2000s, when rates were in the 6% range, we had strong transaction volume. We had 2,300 to 2,500 deals per year. But if you fast forward to 2021, when rates bottomed out at 2.6 and a half, we hit another peak in sales. But what happens after that is interesting because as rates spike back into the 7% range, sales volume actually collapses. And 2023 and 2025 are the lowest transaction years in decades. And so the key insight from that is that real estate prices have not collapsed alongside volume. It's different from 2008. I get a lot of questions from investors on that. It's important to call out, in my opinion, this is a market that's frozen by interest rate lock-in. It is not a market flooded by distressed sellers. And what does that mean for investors? It means that liquidity has significantly decreased. Opportunities are harder to come by in the open market. Rents are very strong and will continue to strengthen as would-be buyers remain locked out. And the real play is the positioning here, using the tax strategies, the wealth transferring tools, and estate planning vehicles to maximize what you already own and being ready when volume inevitably returns. And so, what we're seeing, and again, I'll email you this chart. The next opportunity wave is coming, and those who prepare now will be able to capitalize, while those who wait will inevitably get priced out again. So the question to ask yourself is, what is my next move in this market? This is why we do these webinars, because the investors who prepare and think about their next play during these low volume intervals are going to be the ones who win big. So what's going on now? Right now, we are seeing the biggest shift in history as baby boomers are aging in and out of their homes. And when I reference baby boomers, I'm referencing people born between the years of 1946 and 1964. And what I ask them is I say, are you prepared? Because a lot of people who were born in these brackets, they say, well, they have their assets in a trust, and when they're gone, the kids are just going to fight over it, and that's just going to be that. And so the problem with that is there's usually a home which cannot be physically divided. And my opinion is your current goal should be to ask yourself these questions. What is your ideal scenario for what you have? What does that look like? And then from there, we can determine, where do you start when it comes to making a plan? So why is it so important to have a real estate plan? Well, raise your hand in the chat if you've ever heard of a family who fought over real estate after mom or dad passed away. I mean, I see it all the time. It's just our unfortunate reality. And do you have the right framework in place to ensure that your wishes are carried out, not just in the present, but for the future and beyond? And what I want to point out here is that there are actually two types of property. There's your primary residence, which is going to be an emotional decision, but then there's also the non-emotional decision, the financial decision, the logical, calculated decision. That's going to be the investment property. But what I want to call out here is that regardless of what type of decision this is, all the sales of real estate are a taxable event, and it needs to be planned for, in my humble opinion, because, by the way, we pay taxes to live in our homes, we pay taxes upon selling of our homes, and you pay taxes on the income that you make in order to afford the home. So we can't exactly avoid paying taxes unless you want to go to prison. We have to look for ways to defer the taxes. And this is where we come in. So when we take a look at what homes are in these trusts, these family trusts that mom and or dad are going to leave for the family to fight over when they're gone. First of all, what I like to ask people is, how is your home currently working out for you? How is the home that you live in working out for you? Are you worried about anything? Is your family worried about anything? If something were to happen, where would you go? Who is local or who can help you? Ultimately, all of these questions and conversations boil down to the very last question of, what do we do with the home? And that's where it's important to really think about and really lean on your power team of four, because you're going to want to look at, well, what are the market conditions? And this is where working with somebody like me who's very in tune with what's going on is important, but you also need to know how are we set up for success? And that's where you want to lean on your estate planning attorney. And that's where you also want to look at your financial planner because even if we look at, well, where would we go? Would we go to a retirement community? Well, retirement communities, especially if you go to a CCRC, and this is me wearing my senior transition specialist hat for just a moment, a community care retirement community with all the levels of care in one, they're going to have a significant buy-in in the hundreds of thousands of dollars, plus a monthly fee, plus as our needs evolve and care needs increase, the monthly bill is going to go up. And so a lot of people then have the question, well, what do we do? How can we maintain a high quality life, the highest quality of life for our senior loved one without spending tens of thousands of dollars a month? Maybe there's a way to do that in the home. Maybe there's a way not to do that in the home. Maybe it's one of those things where we have to eat that monthly cost, but at least we know they're safe in a CCRC or some type of retirement community. All of these things require planning with the help of a financial planner, with the help of the family attorney, the CPA, and your real estate planner, because then we can look at what is there, how do we work with it, and how do we plan for the future and beyond, which includes leaving that legacy and transferring that wealth so that it continues to work for the family and has and still maintains the long-term benefit for the beneficiaries of the trust. But that's where we look into, okay, if we have this home, whether it's the primary residence or the investment property, this is where we're going to start. We're going to look at an equity analysis. Sometimes I can get a net sheet from title. Well, always I can get a net sheet from title and look at, are there, is there a loan balance? Is there liens on the home or what's going on here? We're going to take out the cost of selling and we're going to look at what the net proceeds could be from the sale of the home at a certain price. But what the line item that's missing on this sheet is capital gains taxes. Now, I can't go too far into the weeds on this, but when it comes to capital gains taxes, first we need to take into consideration the primary residence. If you live in if you own one home and you live in that one primary residence, depending on who's on title, you could qualify for up to $250,000 or $500 if owned jointly with another person. You can qualify for either $250,000 or $500,000 of credit on that gain from the sale of the home. Now I have a slide coming up that shows the math on what that looks like. But ultimately, you're going to want to loop in the CPA to have this conversation to get an estimate of what could the capital gains tax ramifications be on the sale of the home. So this is the spreadsheet that I use when I work with people to determine the cost basis when selling their primary residence. Now, there are things to look at. A lot of people say, well, should I put my kids on the title of the home because they're going to inherit it anyway? And the answer to that is, I don't recommend that. In fact, I tell a lot of people, if you like your kids, do not put them on the title. Because here's the thing, if you put your kids on title, then they will get the carryover in cost basis, which is not what we want. If you want your kids to inherit a new cost, get a step up in cost basis by inheriting the property through the trust, because if they have to sell it, they would then get a date of death appraisal at the time of inheritance, and that would be their cost basis. And so if they have to sell the property, there shouldn't be any capital gains taxes. But if you put your kids on the title of the home, they would inherit your initial cost basis from when you guys purchased this property. And then if they choose to sell it, there would be a substantial amount of gain in between. And then they could potentially incur some pretty high capital gains taxes. So that's why I say if you like your kids, don't put them on the title of home, put them as beneficiaries in your trust for them to inherit the property through the trust. Now, here's some of the math again, and this is where, we fill out just basic spreadsheets. I print it out and I tell you to give it to your CPA. Like I mentioned earlier, 1 out of every 3 properties in the United States is a rental. And there's a different type of approach to how we look at rental properties because a lot of people own rental properties, and it's important that you ask the following questions. One, does it make sense to keep renting your property out? And this is where we do an asset performance test and we look at how it's performing versus how it compares to other properties that are getting substantial market rent and or a good capitalization rate or a good cash on cash return. Sometimes we look at, do the rental properties or is the rental portfolio able to substantiate enough cash flow to pay for somebody to go and live in a retirement community? And for some people, that is the case because it's just where they're at in life, and that's where we're at. So, can the rental property perform in that regard? There are a lot of questions that we want to ask and we want to understand so that we can ultimately make the decision. Does it make sense to move forward with a 1031 exchange? Now, this is where we're going to get into the weeds. And side note, if you have questions, please feel free to put them in the chat. And so a 1031 exchange is going to be an event by which it allows investors to defer, not avoid, to defer capital gains taxes upon the sale of an investment property when purchasing what the IRS deems as like-kind property within a specific time frame. Does anybody know what happens if you fail a 1031 exchange? You pay taxes. I mean,
Tax.
you pay taxes. So it's very important that you work with the right people who know what the time frames are and know the nuances of a 1031 exchange. So it is called 1031 because of IRS code 1031 that allows someone to defer paying taxes upon the sale of property by simply investing into the purchase of another. So here is the math on why we do 1031 exchanges. So this table compares the financial outcome of selling a property outright, no exchange. This is where we just used $1 million just to keep the math really simple. But this is on the left is no exchange, and you can see that without the exchange, there is $707,500 with which to spend. It's cash and cash in the bank. Now, if somebody does a 1031 exchange on $1 million property, you will see that they have $1 million. It's not cash in the bank ready to spend, but it is $1 million to invest in what the IRS deems as like-kind property. Now, a couple of things on this. And Charles, feel free to interject if you think that you can add some color to this. But it used to be, well, some of the myths around 1031 exchanges are investors believe that if they own a condo, that if they sell the condo, they have to do a 1031 exchange into another condo. And that's not the case anymore, or that's not the case in general. You can go any direction on this chart. There are some restrictions, like, for example, the transaction needs to take place in the United States, but it cannot take place in Puerto Rico. Has to be in the United States and United States territory. We can't be selling property in the United States and trying to do a 1031 exchange into property across the world. It doesn't work that way. So you can essentially transact a single family home and then take the proceeds and invest in a shopping center, a piece of vacant land, a theater. What we see, the strategy that we see a lot of tired landlords doing is going into what's called a DST, and it's called the Delaware Statutory Trust. And Charles is going to cover the nuances of the Delaware Statutory Trust. But before we get to that, I want to go over the time frame and the guidelines for a 1031 exchange. So, when it comes to doing a 1031 exchange, the first rule is the investor must designate up to 3 replacement properties within 45 calendar days of the relinquished property or the 200% rule. Charles, do you want to explain the 200% rule?
Yeah, if you were to, sell $1 million property, the IRS allows you to identify up to 2 million in real estate. So say you wanted to go to four or more properties. Sorry, I guess two makes balloons. Um, if you want to go to four or more properties, you can use the 200% rule that says if you sold $1 million property, identify 2 million in real estate or 20 $100,000 condos in Indiana next to Notre Dame or something, right? So it gives you an idea that you can go to four or more.
Thank you for that. And so when it comes to that, then the purchase of the replacement property needs to close within 100 days from the closing of the property that we've sold. And Isaac, did you want to add anything to this? Because you work with a lot of people as well on, in this process.
You're doing great. I think you're covering everything really well. Thank you.
Well, thank you. Some other guidelines in here that I want to also call out is we have to include a what's called a QI, a qualified intermediary. The qualified intermediary is going to be the neutral third party who comes in and takes the funds from the sale of the relinquished property and moves them over into the new property. So it's very important to be working with a very qualified intermediary who can not only manage the funds, but not lose them, and also be sensitive towards our timeline. There's also here's the timeline. This is just a different visual of the timeline where we see a lot of people get stuck is right where that circle is, the closing date of the relinquished property. We see a lot of people get stuck, and in real estate, we see a lot of people who properties just fall through and don't close. And so this is where people say, okay, well, now what? We have to start over, but our clock is ticking and we don't want to pay hundreds of thousands of dollars in capital gains taxes. So this is where the Delaware Statutory Trust kicks in. This is where we see a lot of people who are not going to close on their original properties, or just the original plan fell through the cracks. And this is why we go into the Delaware Statutory Trust. Now, Charles, can you maybe speak on the bullet points up here?
Yeah, absolutely. If you want, I can pull my.
You're muted, Charles.
Sorry about that. Rookie mistake. Yeah, look at the bullet points here. Is you must be an accredited investor. So what that means is to do a DST, since it's a securitized transaction, you need $1 million net worth minus the value of your personal residence, or make $200,000 a year, single, last 2 years, or combined net worth, husband and wife of married couple of $300,000 a year, right? It's approved by IRS for 1031 exchanges. So the DST is basically an entity that's approved by the IRS to do a 1031 exchange. So it can have one or more investors going to one or more properties. Um, and there's no loan required because we put loan on the property, which I'll go over here. There's pros and cons. There's no control and exit, but you get out of the management, which we'll talk about in a second. And if you want, I can pull up my slides too on the DST if you like.
Not yet, but
Oh yeah,
we've
okay.
got two
Keep
more
going.
to go.
Keep going.
Yeah. So, yeah, these are just some of the intro bullet points to a DST. And then before we really get into the nitty-gritty of that, I want to pull up a couple of wealth building success stories and some real estate strategies that we have seen. So, this was one that I did last year using a debt service coverage ratio loan. And what that ended up being is so a lot of investors, they don't have their financials just ready to go at the ready. And sometimes a property comes along where the financials look great, but you know, we don't want to be running our credit again and going through that application process all over again. We don't have that kind of time or resources at the ready. So the DSCR loan is one that will, like in the case of this property, will look at the income potential for the property, and that is it. And it will loan on that. And so this was an out-of-state property with a midterm rental that backed up to the Indianapolis Speedway. And with an 8% cap rate, the investors were pretty happy with it. And then this other one I want to draw your attention to, this was a tired landlord who had been managing this condo up in Nipomo. Local couple here in Santa Barbara, but they were tired of getting calls and having to drive up to Nipomo a few times a week to do different fixes and do different chores around the townhome. So we sold it. I sold it and we did a 1031 exchange into a Delaware Statutory Trust where they are getting about a 5% return on their investment using the Delaware Statutory Trust. So speaking of other strategies, we had this is one of our stories that we preach loudly from our real estate planning community. We had a client come in, her husband had passed away. Together they co-owned an apartment building. And what they were able to do when we collaborated with the power team of four is we were able to sell the apartment building. And again, this could have gone in many, many different ways. There were a lot of rabbit holes that we went down and looked to see if what was viable. But we looked at what could we do with the funds that made the most sense for the family, and they made that emotional decision to bless their kids while they were still alive. So we were able to do a 1031 exchange and use the funds as a down payment on the homes for the kids, but it was done through the trust. And and the parent, the remaining parent was able to enjoy her final days, in the new homes with her kids. But this was all done with a lot of preparatory work. And like I said, it was done through the trust. So the trust is the one that owns the homes. And that's just another reason why it's so important to have these conversations with the correct power team of four at your disposal. So just seeing what these strategies can do is pretty powerful. And what I want to do is at least just spark your creativity and your enthusiasm to see what it is that maybe you guys can do with what you have. So at this point, Charles, I'm turning it over to you. You have sharing or host power. Let me know if you need anything else. But Charles is going to run us through the Delaware Statutory Trust and why a lot of tired landlords go this route with their real estate.
Yeah, thanks, Melissa. If you want to stop sharing, I'll pull up slides here.
You
Um,
got it.
I've been doing exchanges for about 20 years, working for Inland Securities Corporation. I live in the Manhattan Beach area, and so I've seen over about 4 trillion in exchange volume that I've been a part of over the years. And I'd love to talk to you about the Delaware Statutory Trust in general. I'm going to pull up a couple slides that I use typically in seminars to discuss the Delaware Statutory Trust. And back to that slide that talks about like kind that Melissa's talking about. Again, that can be going from apartments into healthcare to self-storage. It could be air rights above a building, water rights below a building. But the main part of this is the fact that when you look at a Delaware statutory trust and what's being done, the DST is considered like kind by the IRS. As I mentioned before, Many of you have like an IRA, 401k, 403b. It's a tax deferred vehicle, right? That can have one or more investments inside of it. Well, the DSTs is similar in the way that it's the like kind vehicle. It's your qualified vehicle for 1031 exchanges throughout your lifetime. This is created back in 2004-86 of the Internal Revenue Code. So a lot of people are not aware of this, but a Delaware Statutory Trust is a way that you can sell your property and go into a passive vehicle, which I'll talk about here in a minute. Doing a DST, and I'll get through all the details, but the process of it is very easy. Step one is you sell your property through your realtor, like Melissa, right? At Keller Williams. Step number two is the funds go to a qualified intermediary. And it has to be a QI or qualified intermediary because it can't be your realtor, it can't be your friend on the street, your financial advisor, or even me. It has to be someone that's unaffiliated with the transaction or with you. Because as mentioned, it could be tempted to backdate some of the timeline, right? Between step two and three is where the financial advisor comes into play, which we have Isaac Kim on the call here. We'll introduce him after. They can help do the paperwork into a Delaware statutory trust. And since it's securitized, it has to go through one place only, which is a financial advisor. So let's talk about the six major reasons people like DSTs. And in no particular order, I'll go over the pros and the cons. The first reason is you get access to high quality institutional grade properties. So a DST can have up to 500 people inside of one Delaware statutory trust. So imagine we have $100,000, which is the minimum investment for a DST. That's my money, right? We got Melissa's million. We got Katie's 10 million or someone else's $50 million times 500 people. Now we're dealing with hundreds of millions of dollars. So imagine what you could buy. Maybe you're selling $1 million property in Los Angeles, where I live here, which doesn't get you as much anymore, right? But you're going to look for a property equal or greater. Well, imagine getting into a property that looks something like this, these institutional grade properties. It could be ESPN headquarters, which is Inland's property in Bristol, Connecticut. It's a Delaware statutory trust. AT&T's corporate headquarters is an Inland property. It's a Delaware statutory trust. Verizon's headquarters is a DST. Could be FedEx facilities or Amazon warehouses, which many of them are DSTs across the nation, which Inland owns. Student housing, apartments, healthcare, self-storage, right? So these are the typical properties you see in a DST. It might be hard for one person to buy a $120 million Amazon facility or a $50 million ESPN headquarters or a $140 million Class A apartment building. But together, we can buy these types of properties and get safety through high quality property. The second thing is there's no management. Imagine 500 people trying to manage a property together. Wouldn't work so well, would it? So what happens in a DST is Inland does all the management. We handle the toilets, the tenants, the toilets, the trash, the termites, teenagers, taxes, all the terrible T's of ownership. We handle that. You're in a passive vehicle where you sit back and collect the income, right? So every month you get a direct deposit into your checking account or a brokerage account, wherever you want it to go. So you get monthly income. You get monthly updates. You get a quarterly statement that talks about occupancies and what's been done to the property, stuff like that. The end of the year, we give you a 1099. So as Melissa mentioned, you're deferring your state, your federal, Medicare, and recapture of depreciation, right? But the one thing that you can't fully get out of is the tax on the income received, right? But we can shelter it. So I'm going to go over here and show you a sample 1099. I'll blow it up a little bit bigger here. In this sample 1099, this person owns 2.7% interest in the DST. Now notice this is a 1099 and not a K1. I received 5 K1s about 2 weeks ago. So I just finished my extension, which is due October 15th. The nice thing about 1099 is it comes on time between January and March of each year, typically, right? This person invested in the 2.7% of the DST with their investment. They received $77,808 of income over the course of that year. That's what they're taxable on, right? But it's offset by the mortgage on the DST, which we'll talk about in a minute here on a couple slides. So instead of paying taxes on the full 77,000, they're paying taxes on 41,790. There's some sheltering taking place because of the interest expense on the loan. But also, if you're selling a property that has depreciation left over, that can carry over to offset this number even further, this 41,790. Maybe it's $20,000 you're paying taxes on. What I'm getting at is if you're going to get 4.5%, for example, cash on cash income, net of all fees on a DST, it actually might feel like 6 or 7%, depending on your tax bracket, with all this write off and sheltering. If that makes sense to everyone, it kind of gives you an idea of what you're getting in a DST. And a lot of folks are getting more income in a DST than they get on their typical property, especially in California. The next thing is diversification. In a typical DST, you could have a singular property in a DST or multiple properties in any DST. When you look at a Delaware Statutory Trust, as you look through these, um, what you'll find is you might have one ESPN headquarters in Bristol, Connecticut, or one FedEx facility, or one Amazon in that DST. But a lot of DSTs are portfolios. So just for hypothetical sake, just for example, you might have three apartment buildings in Tennessee in one Delaware statutory trust. So your one investment gets you ownership of three apartments in Tennessee. You might have five assisted living facilities in Arizona in another DST portfolio, or 10 storage facilities, hypothetically, in Texas in another DST portfolio. So, as mentioned, under the three property rule, or in this case, the 200% rule, you could take your $1 million property or $300,000 property, whatever it is, and divide it a third into three apartments, a third into self-storage, and a third into healthcare. So you went from one property, one city, one state to 18 properties in three states and three asset classes. Are you diversified? I say the answer is yes, right? Gets you safety through proper diversification. Another thing too is if you're carrying a loan on your property, this is where it gets a little bit complicated. You're selling $1 million property, you have to go back into million in real estate, equal or greater. Anything less is considered taxable. So if you sold a property for $1 million, you went to $800,000 replacement property, you owe taxes on the 200,000 that was not exchanged. The other $800,000 is tax deferred via 1031 exchange. So you can do a partial exchange, but anything you do below what you sold is considered taxable. Where it gets complicated is if you have a mortgage. If you sold a property for $1 million and you have a $500,000 mortgage and a $500,000 sleeve of equity, when you sell that property, logically, your half a million gets paid back to the bank, right? Through escrow. Your leftover money gets paid to the qualified intermediary, which goes into your exchange. Most people have to get new financing to get back to the $1 million mark, right? Otherwise, you're paying taxes, or you can come out of pocket the difference. But think about how hard it would be to get financing for 500 people. How long would it take? How much would it cost? The IRS made a special exemption back in 2004 where Inland could put the loan on the property and you could absorb our debt on paper. What I'm trying to tell you is in a DST situation, you don't have to get financing from a bank. You don't have to replace any debt on your own. We don't even need your credit score. What you can do is replace your debt relative to our debt on the DST, but you get all the write off of the debt past you and the interest expense from that loan past you through the 1099. So you get all the sheltering without the liability. How cool is that? It's a non-recourse financing. So here's an example of a typical DST, right? Let's say you're selling your property or relinquishing or being sold. The left side is you, right? You're selling your property for $1.1 million. You have to buy 1.1 million in real estate equal or greater on the buy side. They're sitting at a 45% loan to value. Inland has a DST that's at a 48.5. So what we're going to do is go 3.5% bigger because it's equal or greater. We found a DST that's just right above what you needed, giving you extra 65,719 in leverage, which is going to give you a little extra tax efficiency, right? And a higher yield, hopefully. So this shows you how a DST works. So we match your debt to what you need based on your needs, but you don't need financing. And think about that. The two hardest things in a real estate transaction, in my opinion, is finding the property. There was balloons again. Finding the property. And number two is getting the financing on it. And both of those are done in advance on a DST because we're holding inventory to those deals. Use this as an estate plan. Maybe you have a revocable living trust set up. Hopefully you do. If not, talk to Isaac Kim, right? Get your revocable living trust set up. The Delaware Statutory Trust can reside inside that revocable living trust. Because think about this. If you're not in a DST and you have an apartment building and you pass away, let's say you have two kids. Of course, your husband or wife, you get to step up, the spouse, but then your kids get to step up after that. But say both parents pass away. Now, two kids own that apartment building. Are they going to agree upon when to sell it? How much to sell it for? Who's going to manage it? A lot of disagreements happen here. Melissa, Isaac, everyone's seen this on this webinar here today, where this gets people in trouble because the underemployed kid wants to manage it. One needs money now, wants to go to Vegas to pay some debts. One's okay financially. There's everyone's in different situations, but the idea is you can put the DST in a irrevocable living trust. That way, when you pass away, your kids get the same step up in basis to fair market value, but now they get this the trust is split 50-50 to two kids. They each share the income until the DST is sold. When the DST is sold, any principal and appreciation goes two different directions. Those kids are on two different trajectories, two different journeys, and it's less likely to fight together. So DST is a great estate planning tool. And there's over, I got this number the other day, 8 trillion in real estate that's being passed down through the baby boomer generation. So 22% of the population by 2030 are the boomer generation, and 8 trillion in real estate is being passed to kids. So we see DST as a viable structure moving forward. In addition, use this as an insurance policy. This is a conceptual idea. If property number one is a DST, property number two and three can be a Delaware Statutory Trust. Use it as a backup. Maybe you're finding that property down the street you want to buy, but use a DST as a backup or in combination with what you're doing because they're all considered like kind. So, in closing on the DST side, yeah, if you're looking for access to high quality properties, which give you safety, get out of the management responsibilities, get some diversification, again, back to safety. Take on a loan that's not really yours, but get all the tax benefits of it, and take the liability of debt off your books. Use this in an estate plan insurance policy. The DST could be right for you. And again, we've bought the real estate in advance. If we have a loan, we went to a third party bank, they've reviewed the deal. We then file it with the Securities Exchange Commission, and it goes to the financial advisors like Isaac Kim, where he has a broker deal that reviews these deals and does also orders a third party due diligence report on the property. So the point here is it's like going to a restaurant, looking at a menu and deciding what you want. And Isaac can show you a great menu of Inland's DSTs and other great sponsors out there that exist. So just a quick review before we move on is step number one is you sell your property via Melissa, right? Step two, you find your qualified intermediary. We can help with that too. We have the complete solution here for this as a team. Your money goes into a Delaware Statutory Trust, and then usually 5 to 7 years, give or take, depending on the DST life cycle, that money comes back to you. And let's say you have $1 million, and hypothetically, you get 1.3 million back just for fun. You got some income and some appreciation on the back end of the deal. That 1.3 million goes back to a qualified intermediary, back to step number two, and the process starts over again. And this process can go on and on through your lifetime. You can swap to drop, deferred to die, and upon death is a step up in basis to fair market value. With that, Melissa, should I give over to Isaac here and introduce Isaac? So Isaac Kim is a financial advisor. And Isaac, I'll let you talk a little bit more about yourself and what you do and how you can help.
Thank you. I don't know if you can see this or not, but Katie had a quick question. She just wanted you to expand on the accredited investor necessity.
Sure. To expand upon it, I kind of gave a brief overview, but to be more specific, is you have to have one of three things. So you check one of three boxes on DST paperwork. And it's a self-attestation, by the way, on your accreditation. One box is you either have, so either or, right? Just check one. Either you have $1 million net worth minus the value of your personal residence. So if your rental property is $1 million, you're accredited, right? But let's say you have a $500,000 rental property. There's a 500,000. You have stocks, bonds, and mutual funds that equal another 500,000. You have $1 million net worth. You may be surprised that you're a accredited investor and not even know it. And that's where Isaac can step in to help determine if you're accredited, because you can look at your stocks, bonds, mutual funds, cash investments, rental real estate, all that can be added up. The other way, so if you didn't check that box, you need to make $200,000 a year if you're single the last 2 years with the expectation of making that this year. And if you're married, $300,000 a year with the expectation of this year. So that is the full definition of accredited investor. And again, you should talk to Isaac because you may be accredited, not know it.
Then let me just hop in real quick, everyone. Thank you for sticking with us. I know this is getting to the end. I have no slides you'll be happy to hear. I just need to talk for a couple of minutes. As Charles mentioned, I'm a financial advisor. I help people manage money. But if you want to buy a Delaware Statutory Trust, that is a security registered with the SEC. And so if you want to buy that, you need a financial advisor in there to help execute that transaction. So that's where I come in. I partner with Melissa and I partner with Charles. If you're selling some kind of rental property or business property, I just want to add one more thing. I can also partner with Melissa if you're selling your residence. And let's say you're looking for a way to mitigate capital gains tax on the sale of your residence, not a rental property, but your residence. Melissa can help you sell the property, and then I can introduce a strategy to you where you can defer the payment of taxes and you don't have to pay it now. So let's say you're going to sell your home and maybe move into senior living, assisted living. Instead of paying tax, we can keep the money in your account, invest more money, and by investing more money, we can generate more income for you in retirement or while you're living in assisted living. And again, that's something where I would partner up with somebody like Melissa. She would sell the property and I would help on the back end with the investing. And that's all I want to say, Melissa.
All right, thank you. So, Isaac, can you check the chat one more time to make sure that we've answered everybody's questions? And
Yeah, I think that's all. Thank you.
okay, wonderful. So, here's our contact information. We do free consultations for people, and I welcome anyone to take screenshots of this and sign up to get on our calendars for a free consultation. Other than that, I don't have anything else. And
Listen, what's the best way to contact? Your image is blocking your information for contact.
oh, bummer.
If,
Well, everybody on this has my email address, so I have a link in my calendar, and they can certainly put time on my calendar by clicking on that link. Otherwise, my email and my phone number are in everybody's inboxes already. But as long as Isaac and Charles's information is up there, that would be great. Uh, Reach out to me, and I'll be glad to put you guys in touch. Is the answer to that. All right. Thank
Same
you,
here.
everyone. Please reach out with your feedback, and we'll see you at the next one.
thank you all.
Thank you all.